Hey there, future millionaire. Today, we be diving into the world of index funds, your ticket to building serious wealth without needing a finance degree. Trust me, this is the strategy that's helped countless people go from zero to hero in their investment journey. Let's start with the basics. What exactly is an index fund? Think of it as a magical basket filled with a bunch of different stocks. But here's the cool part, this basket isn't random. It's carefully designed to track a specific market index, like the S&P 500. That means when you buy into an index fund, you're essentially buying a tiny slice of the 500 biggest companies in America. Pretty neat, right? Now, why should you care about index funds? Well, they're like the Swiss Army knife of investing. You get instant diversification, spreading your risk across hundreds of companies, and the fees are super low. It's perfect if you're just starting out and don't want to spend hours researching individual stocks. But here's where it gets really exciting. Over the long haul, the S&P 500 has returned about 8 to 10% per year on average. I know that might not sound mind-blowing at first, but stick with me. That return means your money could potentially double every 7 to 9 years. And you don't need to be glued to CNBC or have a crystal ball to make it happen. Now, I can already hear some of you thinking, sounds great, but I don't have a ton of cash to invest. Here's the thing, you don't need to be a millionaire to become a millionaire. If you're in your 20s and can set aside just $500 a month, that's about $17 a day, and consistently invest it in a solid index fund like VU or FXAIX, you could be looking at over $1 million by the time you retire. I'm not kidding, that's the power of compound interest and time. But wait, it gets even better. The real beauty of index funds is that they're basically on autopilot. You don't need to stress about picking the next hot stock or trying to guess what the market will do tomorrow. Just set up an automatic investment every month and then forget about it. Seriously, go live your life, pursue your passions, and let your money work for you in the background. This set it and forget it approach is crucial because it helps you avoid some of the biggest mistakes that trip up new investors. You won't be tempted to time the market, which, by the way, even the pros can't do consistently. You won't get caught up in the hype of the latest meme stock or crypto craze. And most importantly, you won't panic and sell everything when the market takes a dip. Speaking of market dips, let's talk about staying cool when things get rocky. Remember, the stock market is like a roller coaster. It goes up, it goes down, but over time, it trends upward. When you see your portfolio drop, and it will, take a deep breath. This is normal. In fact, it's an opportunity. Keep investing consistently, especially during downturns. You're basically buying stocks on sale. Now, I know what some of you might be thinking. This sounds too simple. There's got to be a catch. But here's the truth, investing doesn't have to be complicated to be effective. In fact, some of the world's most successful investors, like Warren Buffett, swear by index funds for the average person. You don't need to be a Wall Street wizard. You don't need to watch the market ticker all day. You just need a long-term mindset and a little bit of patience. That's it. That's the secret sauce. Let us break it down into super simple steps. 1. Open an account with a low-cost broker like Vanguard or Fidelity. 2. Choose a broad market index fund. S&P 500 funds are great for beginners. 3. Set up an automatic investment for every month. 4. Ignore the noise and stay consistent. 5. Give it time. We're talking years, even decades. Remember, this isn't about getting rich quick. It's about building wealth steadily and surely over time. It's about setting yourself up for a future where money isn't a constant worrying, where you have options, where you can retire comfortably, travel, help your kids, or whatever else matters to you. Now, I want to address something important. You might hear people say that the stock market is rigged or that it's too risky for the average person. Don't buy into that fear. Yes, there are risks in investing. Nothing is guaranteed. But historically, over long periods, the stock market has been one of the most reliable ways to build wealth. And index funds make it accessible to everyone, not just the Wall Street elite. Here's a personal story that might help drive this home. When I first started investing, I was overwhelmed. I thought I needed to be glued to financial news and picking individual stocks. I made mistakes, lost money, and almost gave up. But then I discovered index funds. I started small, just $100 a month. It wasn't much, but it was a start. Fast forward a few years, and the growth I've seen is incredible. Not because I'm some investing genius, but because I stuck to a simple, consistent plan. The key is to start now, no matter how small. Time is your biggest ally in investing. The earlier you begin, the more time your money has to grow. And with index funds, you're harnessing the power of some of the biggest, most successful companies in the world. So here's my challenge to you. Start today, even if it's just $50 a month. Open that account, set up that automatic investment, and take the first step towards your financial future. Years from now, you'll look back and thank yourself for taking action. Remember, building wealth isn't about making a few big, lucky moves. It's about making smart, consistent choices over time. Index fund investing is one of those smart choices. It's not flashy, it's not exciting day to day, but it works, and that's what matters. If this video helped simplify investing for you, smash that like button and subscribe to Thrives and Finance for more easy-to-follow money tips. And let me know in the comments, how much are you investing every month toward your future? Let's support each other on this journey to financial freedom. Until next time, keep growing that wealth.